Mr. Bauer is right to point out that increasing capital is not free. It does reduce economic activity. But having capital standards that are too low is very expensive. Just this year, we saw 3 banks go under. This was not a matter of just a liquidity problem. These banks were bankrupt, and the proof is the FDIC sold them for a negative $30 billion. So the market looked at their assets and liabilities and said they were vastly underwater. The cost to our system is not just the $30 billion that will be recovered in effect from depositors over coming years, but the lack of confidence, particularly in regional and community banks, that are still impacting our economy and will for years to come. Banks face 2 types of risks: credit risk and interest rate risk. The risk that the borrower won't pay, or the risk that the borrower will pay, but at a lower interest rate than the bank at an interest rate that's too low given then current economic conditions and the bank's cost of capital. We have a tendency to fight the last war. France relied on fixed fortifications, and we saw blitzkrieg. 2008 was about a credit risk. So now we have Basel III. But 2023 was about interest rate risk. And while Mr. Barr says Basel III does nothing, he's only mostly right. It does way too little with regard to interest rate risk. And there's this myth, and I fear Jay Powell buys into it, that if interest rates go up, the banks will be fine because although the loans they've made and their portfolios have declined in value, their depositors will be lazy and stupid and leave the money in low-interest bank accounts. And I don't think that a financial system based on the idea that depositors will be lazy and stupid over the long term is a sound basis for regulating banks. One thing that needs to be pointed out is that when you focus on credit risk, you take money away from local business loans and the construction loans that we need to build more apartment buildings because the rents are too damn high. When you fail to focus on interest rate risk, you incentivize the banks putting their money in 10-year treasuries, 30-year treasuries, highly rated. You know, Apple can borrow all the money it needs. So a system that underrates the risk of investing in lending money to Apple on a fixed rate 20, 30-year basis and overstates the risk of making loans to people building apartment buildings and building small businesses in my district is a perverse system. Now, we do something under Basel III in the available for sale securities. If they go down in value, that portion of the interest rate risk is captured. But what about those that are supposed to be held for maturity? What about just the basic loan portfolio that is in securities? Basel III is helpful in saying we're not going to rely on the bank's own internal modeling, but that's only as good as the new modeling that the regulators come up with, and let's see what they do. I'm particularly interested, Ms. Philo, in that the risk weight capitals on tax equity investments, where the bank buys the tax credit from the project developer, will increase from 100% to 400% for many banks. Tax equity investments can help low-income housing. That won't be affected. But under this rule, clean energy tax equity investments would face a 4-fold increase under the proposal. Ms. Philo, what effect could that have on our ability to meet the standards of the Inflation Reduction Act, meet our requirements under climate change treaties?
I do appreciate where you're coming from. Different risks, have different weights, and we're relying on the regulators in this process to make sure that they align. I think this is one area where we may wish to see more of that. And may I say that I agree.
On behalf of polar bears everywhere, yes. I want to go on to one other question. Mr. Rocksmith, I'm told that we're going to have no credit for mortgage insurance. Does that make any sense?
Nonsense. It makes no sense at all. We should encourage banks to use other sources of loss-absorbing capital in our marketplace, and this gives no credit for private mortgage insurance.
Thank you.
Gentleman's time has expired.